Hello everyone. In this lecture, we shall be discussing the basics of derivatives. So this is chapter 9, Derivatives Analysis and Evaluation of AFM. Derivative is a product whose value is to be derived from the value of one or more basic variable called basis or underlying assets. This looks quite confusing, right? It says there is a derivative and this could be a product, or let us say it could be a contract or agreement. But the problem is this derivative derives its value from an underlying asset. The value of this underlying asset decides the value of this derivative. Now let us try to understand this with the help of a simple example. I wish to buy a house. There is a house available near my place where I stay, and I wish to buy this. The owner of the house has quoted a price of 10 lakhs. This is a very simple example. Okay. The owner has quoted a price of 10 lakhs. I am expecting that the value of this price in 1 year will be 15 lakhs. This is my expectation. Okay. My expectation is the value of this house will become 15 lakhs in 1 year. So I really wish I could buy this house now so that I can make profit of it after 1 year. Now I approach the house owner. But the problem, there is one simple problem here. I don't have money. I don't have 10 lakhs with me to buy this house. So the owner is like, boss, without money, how can you buy this house? I'm not going to sell it. I need money. But then I go and check my fixed deposit and all my investments, wherein I understand that after 1 year, I will have enough money accumulated in my fixed deposits and investment so that I will have enough money to pay for this house. So again, I approach the house owner. I'll pay you after 1 year. Can you sell me the house? House owner is like, boss, that is not possible. How will I trust you? And also that is not correct. I don't want any such things. I just need either you take the money, give me the money, take the house. That's it. So then I again approach the house owner saying, okay, let us enter into a contract. Let us enter into a contract. What is the contract is? I will buy this house at the end of 1 year. I will buy the house at the end of 1 year and I will pay you the compensation or the consideration at the end of 1 year. The house owner thinks a bit and he said this is a fair deal. But do you think he will agree again for 10 lakhs? No. He's not going to agree for 10 lakhs because at least he need the time value of money, right? The interest of 1 year, because the transaction is not going to happen here. He was ready to sell the house now at 10 lakhs. He may say another 12 lakhs. He need 2 lakhs also. But then you may ask a question. See, the value of this house was 15 lakh after 1 year. Why did the house owner agree to sell it for 12 lakhs? See, this is whose expectation? This is my expectation, not the house owner's expectation. It may or may not be correct. I would have other plans. I am foreseeing certain things which the house owner may not be foreseeing. I am expecting it will be coming at 15 lakhs. But the house owner is like, chalo theek hai, I thought I'll sell it at 10 lakh now. He's anyway signing an agreement. Agreement is valid. I'll get 12 lakhs after 2 years. Also, I need to give the house to him after 2 years. So this agreement is signed. This contract is signed. Now, this contract comes under the purview of a derivative. Now, let us see the value of this contract is derived from the value of underlying asset, which is the house. And let us see how, when the value of the underlying asset changes, the value of derivative also changes. Okay. Now, we are at year is equal to 0. Here we are entering into the derivative, which is to buy the house at year 1. Now, what is the expected value at year one? Is 15, right? At what rate am I saying I will be buying this house? 12. So both are going to happen at the end of year one, and I'll be making a profit of 3 lakhs. So as per the agreement, the consideration which I have to pay is 12 lakhs. So this is as per the derivative contract signed. And the expected value of that underlying asset is 15 lakh. And this is expected at the end of year one. So at the end of year one, I can simply take the house at 12 lakhs and sell it in the market at 15 lakhs and make a profit of 3 lakhs. Clear? Now, before going further into the valuation, let us discuss one more thing, the purpose. Why did any person sign on this agreement? See, why did I did this agreement? Because profit motive. I am expecting this particular value of the underlying asset to be 15 and I'm signing this derivative at 12. So my purpose is what? Profit motive. What is the purpose of that house owner? Why did he sign in this document? Fear, uncertainty. He is owning a building and he wants to sell the building. He is not sure what could happen in future. What if the price comes down? What if that person is not finding any buyer for his asset? So in that case, out of uncertainty, to hedge the uncertainty, to hedge the risk, he is entering into the derivative. After all, he is also signing the contract for 12 lakhs, which is a little bit higher than 10 lakhs. So time value of money is also considered. So whenever a derivative is signed or entered into, these will be the motives. Either it will be to hedge a risk or a person who just want to make a profit out of arbitrage. So these are the two purposes for which derivatives will always be signed, either to hedge the risk, to save from uncertainties, or with a profit motive. Now let us go back to our example. The expected value or at the end of year one is 15 and the consideration as per agreement is 12. So with this, the value of this particular agreement is 3 lakh for me. Because I have signed into this agreement, I am going to make a profit. So the value of this agreement is 3 lakh. Due to this agreement, I am going to make a profit of 3 lakhs. So that is the worth of this agreement to me. Now, as time passes, at the 6th month, what happened is this particular location where the house is, there some flood happened. It is a flooded area. It got flooded in rain. And the value of this particular property went down. It came to 13 lakh. Means the expected value at the end of year one. This is not the value as on date. It is the expected value at the end of year one. It became 13 lakhs because the current present market value also went down. So I'm also expecting at year one also, end of the year one also, it will be the same value. And the expected value came down to 13 lakhs. Now the consideration as per agreement is still 12 lakh. I will anyway have to, whether the value of the property changes or not, I will have to pay 12 and get the property, right? So because of this change, what is the expected profit? It is now 1 lakh. Now this is the value of derivative. Now here you could see when the value of underlying asset changed, the value of derivative also changed. Clear? Same could also happen when at the 9th month, suppose there is a huge residential boom and all properties are highly priced and the value of this particular asset has increased and maybe say 20 lakh. In such a situation, still at the end of 1 year, that person will be forced to sell me the property at the return as per the return agreement at 12 lakhs. And see what is the expected profit, 8 lakhs. So the value of the derivative increased because of increase in the value of the underlying asset. This is why we say A derivative is a product whose value is to be derived from the value of one or more basic variables called basis or underlying asset. So derivative is a product. What is the product in our example? The agreement with the house owner. And the value of this agreement, it kept changing. It is derived from, this value is derived from the value of basic variables called basis or underlying asset, which is the house in our case. Clear?